Good day, fellow deal makers. Welcome to the Deal Scout. Hey, just real quick, everybody. We're going to have conversations with investors and with people, service providers, and all sorts of deal makers. I want to tell you this. Use wisdom, use discernment, do your due diligence. I have to now give a lot of disclaimers because of some extra licensure I got. So, as always, this is for us to all learn and grow together. But at the end of the day, use prudent wisdom and diligence in your decisions. This is not investment advice as we come across here. This is for us to learn and grow as a community. All right. So with that, let's rock and roll. We're having a conversation with a new friend who has an incredible beard. And as we were talking, like I do have some beard envy. As we were talking, some of the stuff that he does, he related to this. He goes, Josh, have you ever seen the show Billions? And I was like, oh, it's one of my favorite shows. He goes, I help people with their mindset. I'm kind of like the Wendy Rhodes. And I was like, boom, she's my favorite character. Let's chat. Ladies and gentlemen, Mr. Anmol, welcome to the show.
Thanks for having me. Looking forward to chatting with you.
Yeah. So you probably never had that kind of intro before, but as we dive in, if we were to meet for the first time in a coffee shop, what would you say it is that you do?
So I provide people 3 tips on how to grow an amazing beard. No, I'm just kidding. So, I think what I do is I teach people how to trade and invest in the stock market so they can do it by themselves, as well as how to stay mentally focused and calm while they're actually in a trade or investment. Because that's psychology is 90%. Trading and investing psychology is 90% of the missing piece because everybody learns strategies, but they don't learn how to follow it. So that's kind of what I help them do is learn how to trade the stock market, but also be emotionally stable while you're doing that.
Yeah, I would say I got involved, like I feel like anytime I learn something, I'm the kind of guy who runs into it. So I learned a little bit about options and trading options. So I went and I bought all these options. And then, if I'm looking on my thing and I see them in the red, I'm like, oh crap. Or so there's an emotional piece. And every time I get a ding on my phone, I'm like, is it up? Is it down? So, when we talk about the psychology and the emotional stability of buying and selling stuff, there's a huge component there because I've made poor decisions when I made an emotional click to buy or click to sell. Kind of walk us through what you have found as an emotional stability, emotional guidance for buying and selling stuff, for being an investor.
Yeah, I think the most important thing is to have a plan, right? Just like you wouldn't enter a business without a business plan, you shouldn't be entering a trade or investment without a plan for that specific trade or investment. So I think a lot of people trade end up basing on their emotions, on how they feel about a stock. Oh, I read this article, the stock's going to go up, or I feel this stock is a great investment. So when you do it based on feel, then you're relying on emotions, you're relying on feel, and those emotions will eventually let you down. Where the stock is going down, and rather than getting out and taking a quick loss, you keep holding. Maybe it'll come back up. It's a great company. And then now you're tuning into listening to the earnings reports. Now you're that involved in the red, or you keep buying more. Maybe I'll average down and it'll come back up. Those are all the pitfalls people fall into without a plan. And likewise, if the stock is actually going in your favor and it's actually producing results, rather than taking a profit, they'll keep holding. Maybe it'll go higher. I think this is going to be the next big thing. And without a plan, you're basically on the whims of the market. They're up, they're down, and you don't have a specific plan. And that's what, because you entered a trade or investment with an emotion based on feel, you're also going to get out based on feel. And that way you're going to get random results. There's unpredictable results, right? You're probably not going to beat the market doing that. And I think that's one of the things where you need a plan, where every trade or investment we take, we know exactly where we're going to get out if you're wrong, but then also exactly where we're going to get out if you're right. And when you know those things, it's freeing. There's no emotional struggle. There's no hurdle. You don't have to worry about anything. You're like, okay, has it hit my exit points? No. Okay, I'll just keep holding. And you need to look at the stock. You don't need to do a lot of those things. So I think we need to define the exit points, because when you can define your exit points, you also know exactly what you're going to lose, right? Let's say if your exit point is $5 below the current stock price and you bought 1,000 shares. Well, if it goes down $5, you're going to lose $5,000. So you already know what your losses are, and that removes all the uncertainty. So I think that's one of the things I help people with is stay focused in a trade and focus on your actual data that you've back tested rather than trading based on a feel.
Do you that's such have a plan? Actually, that sounds like a really smart idea, right? Like I did not have a plan when I was buying these. I was like, I looked at the company, I looked at the financials, and I was like, it seemed like, it's a value purchase. Why not go for it? And then I see it go down and down and down, and I'm like, my emotions get involved, and now I'm like, my emotions are tied to it. How do you determine as you're doing this, what are your lower limits and your upper limits when you're doing stuff? Because when it's going up, you're like, now I want to ride this baby to the moon. How do you know when to pull chips off the table? So kind of give us your frameworks on the upper and lower side.
Yeah, so it's kind of like a poker player, right? You know when to hold them, know when to fold them. You got to know that. So I think with that, what we do is we look at charts. So technical charts, technical analysis, looking at the price history of the stock, and then that's where we determine those levels off. If there's a clear level where the stock goes down to $50 and it bounces to 60, then it goes down to 50, then it comes back to 60. So we know it's in a range between 50 and 60. So if we're going to be in a range, we don't expect the stock to do a whole lot. We're just going to trade the range, both sides, right? Buy it at 50, sell it at 60. But then when it finally gets above that range, 60, let's say for the first time, now it's at 62, then the likelihood is it's going to start a new uptrend, right? So then we know we're going to buy above that 60, right? And we're going to ride that uptrend. And then our lower limit is going to be whatever the floor was of $55. So every stock would have, support levels or resistance levels where it struggles into. So we're just trying to time it where our exit points are based above and below those levels. So it's going to be different for every stock, but it's purely based on charts and technical analysis. Because oftentimes, you might have a great company and it might actually be a great company, but the market is a mechanism that front runs what people think now. And it does that a while ago. For example, Zoom, Zoom Communication, their stock is down 90% over the last like 3 years. It's not that it's not a great company. They're actually more profitable and doing better business now than they were 3 years ago. But the market front run that and the stock went from 50 to 500, right?
Mm.
And from 500, the hedge fund sold it, and now it's slowly starting to come back down, and now it's at 50. But recently, for example, it seems to have found an area. So that's just an example of something that we might do, not necessarily like financial advice, but what we're looking to do is we're looking to find these stocks when nobody else wants them, when they're beaten down and they're just kind of chopping around, nobody cares about it anymore. So we're trying to buy them before they start that uptrend and learning how the markets will always front run everything, like all these stocks, Peloton, Zoom, Roku, Spotify, all of these in 2020 were up like 90% higher than where they are right now.
Yeah, historically, and this is based on your experience. We're not telling people, "Hey, go do this." I just want to be like really clear because sometimes people just take and run with information as they hear stuff.
Mhm.
When you look at a company that maybe has lost 90% value, or you look at a company with potential value, or that you people aren't paying attention to it, how
Mhm.
do you like? What are some indicators that you look for to see that this thing might one day go up? What do you look for?
So in technical analysis, there's four market stages, right? Stage one, when the stock is simply going sideways, it's not really going up or down. And then once we get above that sideways consolidation, we start what's known as a stage two uptrend, where the stocks now start to uptrend. And then typically around the top, you'll see the start to slow down a little bit, they start to round up a little bit. That's called a stage three, where we start to go sideways again. And then comes stage four, when we break below all of that and then we start going down. So this is kind of like a bell curve. The cycle repeats over and over and over again in everything, whether it be crypto, whether it be, utilities, whether you're trading commodities like gold, silver, or any stock. All of them have the cycles of sideways, up, sideways, down, and they keep doing that. So as a technical trader, we don't get caught up in I love this company. Honestly, we don't care about a lot of the companies we trade because we are so detached to the outcome or like our own biases of this company being the next big thing. We're just stepping up, taking a step back and see, okay, which stage the markets are in. If it's in a stage four downtrend, it's going down. Okay, we're just going to let it go down. We're not going to buy it until it stops going down and now starts to go sideways again, right? And now just stop going down. That's what we call accumulation phase. That's where funds start accumulating the stock when nobody else wants them. And then when they're done accumulating, it typically will start a stage two uptrend again. So we're trying to, for me at least, my strategy is timing those like stage one to stage two transition points.
Yeah.
So it's
Now,
getting I feel like it's getting a little complicated because without the visuals, then maybe the listeners are like, "What the heck is he talking about?" But
yeah.
it's just the market stages where we're taking a step back and just asking ourselves the question, which trend is the stock is in? If it's in a downtrend, don't buy it. It won't randomly just start going up, right? We want to first let it settle in.
Okay. So as you're looking for those kind of as you're looking for opportunities, like how do you know? Because there's I think 3,500 stocks out there just on New York. I think there's like 3,500 or so publicly traded companies that you could buy and sell on New York Stock Exchange, Nasdaq, or there's even new ones coming up into the marketplace. So like, how do you sort through and look through that there's a lot of information there, a lot of data. How do you narrow that down?
Yeah, so I think the first step, which I tell people, is because people love picking companies. That's just our human nature. We feel like we want to find something, right? So the big thing is you make a list of all the stocks you like. Just make a watch list, right? So put it everything in there. You like Tesla, you like Microsoft, you like just make a whole list. You might come up with like 50 stocks, right? Then we want to go through that list based on the monthly charts or weekly chart time frame of those trades, and then we're looking to spot that bell curve, right? And you would notice that. So your listeners can pull up charts off, as an examples, Teladoc, Roku, Zoom, Spotify, Shopify, PayPal, Alibaba. If you plot out this stock, you'll start to see this exact same chart on every single one of them, including Coinbase and all of those ones. And you'll also start to see after they stop going down, they'll start to go back up again. So then once you have a list of 50 companies that you love, we go through all of them on the higher time frames and we see which chart they're on. And I'm only going to try to buy something that's either in stage one or entering a stage two uptrend or just started a new uptrend. That's what I'm trying to time a lot of those entries. So out of those 50 stocks, as you go through them, you might only be left with like 10 that are actually meeting any technical criteria. But obviously, there's a lot more like technical chart patterns and stuff you look at
Hmm.
to kind of shortlist that into maybe five that you really like or 10 that you really like.
Yeah, interesting. What do you think people feel more? Right. So let's just say they got into it. A lot of people won't even ever get into something. They'll read a million books about it, and they won't invest that first dollar, right? But let's just say they've taken that step. They've taken that step. What do you think people feel more when they have a big win or when they have a big loss? What do you feel more when that happens?
I think big loss for sure, right? Because big win, you're kind of like, okay, these were my profits that I'm giving back, and you kind of live with it, right? But when it's your own money that's actually going negative, there's not like a profit that you're losing, but your own money, that's a tough one because it takes a lot to come back. If you lose 50% of your account, it doesn't take you 50% to come back. It takes you 100% to
Yeah.
come back to just break even. So like the loss of the hard part. So the if the biggest thing is controlling losses. So what we try to do, or what I do for my trading, is like all of my losses are exactly the same dollar amount, all of them, right? Like plus or minus, like here and there based on slippage or where you got filled on the exit. But all of my losses will be exactly the same dollar amount. And typically, all of my winners, I try to make them twice the size of my average loser. So by that ratio, I only need to be right 40% of the time. I could take 100 trades, I could lose on 60 of them. If let's say on 60 on them, I lost 1,000 each, I lost 60,000, right? But then on 40 of them, if I make twice the amount, right? Net, I'm going to be profitable. So by that measure, you don't need to be right a lot. You only need to be right, 34% of the time to end up, profitable at the end of the sample size. So that's kind of the statistical approach that we use. Keep the losses the same, try to make the winners twice the size of the losers. And then you only need to be right 40% of the time. But typically, with the right analysis and the right things, you're still going to end up being right 60%. And that's a really good ratio to make money. So it's not,
Interesting.
yeah. So most people think you need to win like 90% of the time, or good traders win 95% of the time. Not true. Good
Yeah.
traders win 50 to 60% of the time, but their winners are much larger than the losses are.
Yeah. Now, I was trying to, I was studying up on like how an active trader, like what does an active trader look like? Someone who does really well in the marketplace. So if you look through, how do you know if someone's doing well or not well if someone's an active trader?
Oh, by looking at their spreadsheet. So all of the traders that I coach, you have to track all of your single trades you take on a spreadsheet. And then we track them very granularly, like what time did you take that trade? Was it a long? Was it a short? Or the price of the stock? Was it like $50 to $100 price range of the stock? Was it a $0 to $10 price range of the stock? And then we're also going to look at the timing of your trade. Was it in alignment with the market's trend overall, or were you trading counter trend? And then we're also going to track, was it a breakout trade versus a pullback trade, buying on the way down? So we track every little thing. So then at one glance, I could take a look at any trader spreadsheet and I could see what his win-loss ratio is, what his Sharpe ratio is, what his win rate is. And then based upon that, we'll calculate the expectancy of the model by using the win-loss ratio and the win-loss percentage. That gives us an expectancy number. As long as that expectancy is positive, then that the system is profitable. All you got to do is just keep doing it over and over again. If
Yeah.
the system is negative expectancy, then no matter what you do, it's going to lose money. In fact, the more you trade, the more you're going to lose. So just like a casino, we're trying to get the edge in our favor. That even if it's like, okay, expectancy of 0.2, that means every trade is going to make me, $20 or something like that, and I just got to keep doing more and more of that. So so that spreadsheet tells us that, and then also the reports section of our spreadsheets that we personally use, as I was saying, we track granularly. Like if I notice the best day trades that I take are between 10 o'clock and 10:30. But somehow when I trade late in the day, like 12 p.m. or 1 p.m., my sample size is not that great. I lose, right? So the next month I'll make an adjustment. I'm not going to trade the afternoon. I'm going to focus on this, specifically the morning trades. So we'll keep fine tuning our data. Maybe turns out I'm better when I'm shorting stocks going against them rather than when I'm buying stuff. Then I'll do more of the shorts and cut out the longs. So I'll use my spreadsheet to make the decisions to optimize my back test and my data set.
Okay. Now, for someone who's good at this, I always have the question is like if you're so good at this, investing strategies, and if you're so good at it, why are you teaching people to do it? Why are you building courses and coaching others through it instead of just focusing down and, just crushing it yourself?
Yeah, great question. And we do it ourselves, and we're doing really well. We're crushing it with that. And I do it. Our name of the company is Live Traders. So the way we named it is because we trade live every day. My account's up there on the screen, and I'm doing my thing live. Win or lose, people get to see it in real time. And yeah, some days I have bad days, some days I have good days. But I think that's the best way for people to learn is to just watch somebody do it, and then more importantly, see how I handle myself when I lose. I think that's more important than when I'm winning, because everybody online wants to talk about their winners. Like some
Yeah.
days I'll lose and I'll be like, okay, here we are. And you can watch me not be undisciplined or not trying to get my money back or revenge trade. So I think that's the best way to people to learn. But also I think it's a community. Like for me, one thing that I learned early on when I was and I started in trading, it's a very lonely business. There's no employees, there's no bosses, there's no colleagues you go out after work for drinks with. It's you and your computer. So for me,
Yeah.
the reason I started this whole chat room community is for me to find a community. Like, people pat each other on the back when we're doing well, when we're struggling with lifting each other up, we're sharing ideas. And what it also gives me is like hundreds of eyeballs that I've trained, right? And they're finding stuff for me. Hey, Anmol, this stock looks like it's doing that pattern you talked about. And I might pull it up and I might actually trade it and make money on it. So there's so many benefits in addition to the money you might make running a business, coaching people. But the
Yeah.
other benefits are you get a community, you get hundreds of eyeballs looking, scanning the markets, thousands of stocks based on what you've taught them. That eliminates my downtime to find the good ideas. And then obviously, there's nothing special that I'm doing for them. It's not like I'm taking time out of my day to like coach people. I'm doing my trading. I'm just going to live stream it. You want to pay for it? Great. Learn something from me. But so there's no change in my schedule. I'm doing what I would be doing anyway. If I wasn't live streaming, I'd still be doing my own trading. So for me, it's just like, why not kind of a thing? And it's a great business now that it's transformed like hundreds of people's of live. 5 of our students are running their own hedge funds at the moment, a couple of hedge fund clients that I advise on psychology. So for me, it's led on to many opportunities and doors is open for me that I might not have if I was just being selfish and just trading on my own and not sharing my knowledge with anybody.
Yeah. So let's do a Wendy Rhodes session, right? So let's just say I'm a trader and I come to you and I say, actually, what would be the number one thing people come to you like, hey man, I'm in a downspout, I'm in a dry season, no, none of my trades are working. Is that how people come to you? They're like, dude, I cannot, whatever, right? Is that the typical request?
Yeah, either it would be that, like if I have a hedge fund client, they're typically coming after like a downturn. So I had this hedge fund guy, massive hedge fund. I think they managed like probably 20, 30 billion in assets. So they had a 60% down year a couple of years ago. And, with crypto going down, a lot of their fund was in there. So it was about, managing their state of mind so that they can focus on looking at what's coming rather than what's already happened and not dwelling on what's happened on how we're going to make a quick comeback, but okay, how can we sustainably build a comeback? So with hedge funds, it would be more that. Whereas individual clients who are retail traders like me, then they might come to us and say, okay, I'm just not getting the performance or I'm in a slump right now. Or it could also be that they're like, I'm taking the exact trades and they're doing exactly what I thought they would, but man, I just keep getting out of them. Like the winning positions, I just keep selling them too soon. I feel jittery that it might come back down. I don't want to lose the profit, so I take quick profits. And then the losing positions, they might not get out of them. They just keep holding, they keep averaging. Now, those are all psychological issues that are very deep, because, most people say, oh, you can't go broke taking profits, right? That's a popular saying in the markets. But that's exactly how most people go broke. Their profits are so tiny, but their losses are massive. The data is never going to work. So for me, I get them to kind of go in the state of mind, usually includes a mix of visualizations, hypnosis, and NLP. So kind of get them to go internal and then walk me through exactly their process and that moment when that felt that jitteriness coming, or they wanted to get out of the position, or they're down, like they're seeing $5 million down on the P&L statement in their fund, or how do we get past that? So getting them to move into a state of mind where you're not making emotional decisions, but kind of reverting back to what does our plan say, what does our data set say? Because the data long term will be the data. It's going to produce what the data says it's going to produce. So just coaching them through that and how to be mentally stable and giving them exercises to, walk up and leave, like not get too focused. Because traders, that's the worst thing that can happen to us if you're actively trading. You get stuck in your computer and you just want to get your money back, right? So
Oh, yeah.
get into that frame of mind. We saw that in the financial crisis, the amount of people on Wall Street here, like people were jumping off the buildings. Hedge fund managers were jumping off the building financial crisis, right? Because they just over leveraged themselves, didn't have an exit plan, and they couldn't handle it when their loss came in. They had no data. It was all field-based floor trading and all that going on back in the day. So just learning from those, because you're trying to build a lifestyle, you don't want to kill yourself on doing it.
Yeah, nobody, I don't want that for anyone. How do you protect yourself as if you're a trader, how do you protect yourself in terms of like to make sure you're not getting in where you're now over leveraged, you put your car, your kids' college fund, you've went all in on this thing on a good gut instinct or on maybe even some good historical data, but there's a systematic, market thing that just happens that's out of everybody's control. How do you protect yourself against yourself?
Yeah, so there'll be two different ways to do that for traders and investors. So for traders, as I said, we already need to know the exit points if you're wrong. That's before you get into the trade, not after. Before we get into the trade, we know, okay, if it goes down to this, I am out. And then if we know it's going to go down to this, for example, you buy a stock at $100 and it goes down to, let's say, 99, right? So you're risking $1 per share, right? So then if I only want to lose a maximum of $1,000, then I'm going to buy 1,000 shares, right? Because if I buy 1,000 shares, it goes down $1, I'm going to lose $1,000. So you already know what the loss is, so there's no uncertainty. For investments, it's going to be different because you're not getting in and out. So for investments, it'll be like, okay, having a diversified portfolio, more than 10 stocks, right? And then what you also want to do is make sure, a lot of people say, I'm diversified on Anmol. I have Amazon, Google, Microsoft. I'm like, no, you're not diversified. That's all tech. The tech sector takes a hit, you're done. Everything's going to go down. So diversification truly means across sectors. So having some tech stock, having some energy companies, having some gold, right? Having some bonds, like you build a diversified portfolio. So not everything is going to go down. Typically, if you see stocks start to go down, but bonds and gold and silver will still go hold up. So your money's protected. And then so for that'll be for investments. And then not having most of your eggs in like one stock. Like a lot of people did that. I'm going to put all my money in GME, or AMC, and you're done, right? So you never want to make like, okay, Tesla is 50% of my portfolio, and then you have like 5% in all the other stocks, but still that's not diversified, because if Tesla goes down, 40% of your portfolio is going to take a hit. So ideally, we try to create a ratio where each position is maybe like, let's say if you love a stock, yeah, that 10% of your portfolio or 15% of your portfolio. But then there's other 85% divided into a lot of different stocks. So that will be for investments. And then also when you get into investment, have some sort of exit in mind. What if I'm wrong? When do I know I'm wrong? Because you can't keep holding a stock forever. There's also opportunity cost.
Yeah.
Because you can get out of a stock and get into something else and make your money. So the questions to answer is, how do I know if I'm wrong? And how do I know if I'm right? Right. So one of the biggest early lessons I learned early in my day when I was working with this venture capital guy in Sequoia Capital, he asked me, okay, before we make any investment in Sequoia Capital, we ask ourselves the question, is this industry, business, product going to be more relevant or less relevant in the next 5 years? If the answer is yes, great, invest in them, right? So just based on that question, 5 years ago, I would ask myself, If I put money in Tesla, is Tesla going to be more relevant or less relevant in the next 5 years? More. Okay. That could be one of my investments. Is Amazon, are more people going to be using Amazon or less in the next 5 years? Probably more, right? So if the answer is less, then you don't want to invest in it. So the answer needs to be more to that question. And then you need to know, okay, how do I know when to get out? What is my target if I'm right? And what is my exit point if I'm wrong? And those needs to be predefined.
Predetermined, which comes along with the plan. Where do you see in your prepping for success and success journal, like where do you see in terms of mindset? What are some ways that I could start building up a healthy mindset towards investing? Like what are some of the key points that you have, after coaching a bunch of people?
The biggest one is being a person of integrity, right? Do what you said you're going to do and do it when you said you're going to do it. And do it because it's the right thing to do, not because of anything else. So that basically applies to all areas of our life, whether it be trading, investing, business, or our personal life, is like following through on our word, right? We're really making sure we mean it, because a lot of times people would say, I want to buy this stock and then, if it goes up there, I'll sell it and it goes up there. They're like, no, but I think the company's doing really good. I think I'm going to hold it. It's going to go higher. But you said you're going to sell it and you got the opportunity. The universe literally gave you exactly what you asked for, is at your target price, and now you're going to be greedy. Or if they say, you know what, if the stock breaks this $40 level, every time it goes to 40, it keeps holding it. So if it breaks 40, I'll get out. It breaks 40, you're like, but I think there's 35, and maybe you hold it there. And then you just start manufacturing stuff. So you never follow through on what you said. You didn't follow through on your own word. And that's a lack of integrity. And then, people would say, oh, but Anmol, I'm a person of integrity. I'm like, really? When's the last time somebody called you and you said, hey, I'm just in the middle of something. Let me call you back. And you never did, right? Or you ran into an old friend at an airport or a shopping mall. You're like, hey, good to see you, buddy. We should totally catch up. And then you make no attempts to ever catch up with them. You never follow up. So you basically just said something, but you
Yeah.
never actually meant. So think about why that happens, right? We're trying to look good in front of other people or not look bad. So we just say things to sound nice. But what you're really doing is there's an unconscious low self-esteem, right? Because you say things for the sake of saying it rather than just saying no, right? Or like, don't say if you don't mean it. Because those little negotiations we make with ourselves internally, right? I mean, I just discovered that about myself when I was like, I'm trying to lose weight, I'm trying to get healthier. And I'm like, oh, I'll go to the gym from Monday. And Monday comes in and it's like the 28th of the month. So you're like, I'm just going to start from the first. And then the
Yeah.
first comes in, but it's November. So, well, I'll just start from January 1st, right? And we just keep moving the buck forward on our own goals rather than saying it and doing it. Like you say something, you do it and take action on it. And that integrity piece is the most important critical element of making it in any endeavor that you take on in life.
So you think that integrity piece makes you a better trader?
Everything. It'll make you a better human in like all aspects of your life. Because I mean, let's say a lot of people, how many people said, I should be investing in the stock market. Next month I'll start putting 10% of my profits into stock. Next month comes in, they don't do it. Oh, but market's too high right now. I don't want to invest right now. Right. And then the market comes down 35% in a few months from now. They're like, oh, I think it's going to be a crash. I don't want to invest right now. Right. So they keep saying things. They never actually do it. Now, 10 years later, they still haven't invested. What if they started 10 years ago? Your money would have more than tripled, right?
Yeah.
So those are the things people miss. They say things. How many people, you probably know so many people who before 2020 were like, man, I want to start my own business. If I just don't have enough time, I have a job, one day I'll start my business. Then comes COVID, everybody's stuck, locked into your house. You have all the time in the world. Still, nobody did it.
Yeah. Yeah.
Lack of integrity.
We've seen that. Oh, I can't wait. Hey Josh, I'm gonna start a podcast show. Could you blah blah blah. Hey, I'm gonna start a business. Could you invest, all this stuff. And it's true, man. If you're not, that's a great point. If you're not being honest with yourself, do I really expect you to be honest with me or an external person, right? Wow.
Right. Yeah.
Interesting.
You don't keep the word to yourself. How do you expect your clients? How do you expect the universe to believe in you? You don't believe in yourself.
Ooh. So as you're doing this, you've got this live trader, right, where people could go on and what is the website again?
So my website is unmol.net, but the trading website is livetraders.com.
Livetraders.com. And they could actually watch you trade. So as you've got your headphones on and you're talking through trades and this is what this looks like and that's what that looks like. What when you started that, what was your concerns with starting, that live trading? Because one, I have enough anxiety just getting into an investment in the first place. Having people look over my shoulder, terrifying, bro. How did you do that?
No, I did it specifically for that purpose because I had my own psychological issues. Like, because when nobody's watching, how easy is it to mess up, close your laptop? Nobody will ever find out the stupid thing that I did today or the
Yeah.
money I lost today. Very easy to get carried away. So I did it more like a self-accountability. Dude, every day is live stream. Thousands of people watching me do this live. I can't mess up. I can't do stupid things. I have to lead by example. So that actually made me a way better trader than I was like 10 years ago. My trading every year has gotten better just because of like there's people watching me. I can't have to set a good example. I can't be the one holding on to a losing position. I can't be the one, saying, teaching one thing and doing the other. So for me, it was like a way I originally started as like self accountability, and then it just developed into like this whole community, and then everybody's developing, getting better. So that was kind of the big motivation. The other motivation also was at least when I started in this business like 14 years ago, there was nobody doing live trading.
Yeah.
Everybody would just sell a course and then you do it yourself, right? Nobody wants to show people how to do it. And that was kind of the biggest ick that I had within the industry is like you'd hear ads about how to turn X into $1 million. It's all crap. It doesn't work like that, right? And then likewise, everybody would talk about the amazing gains they had, all the winners trading they called. Nobody talks about the losers. So for me, that's why we call the company Live Traders, is that, hey, we're just going to do it live. So what you're going to see us teach you in the course, you can see us actually apply that same technique that we taught you in real time. So it's not like you take a course and then the guy's doing something completely different on himself. You can actually see what I'm teaching is what's going on in the live streams.
Yeah. Do you have any haters out there? People who watch and they're just like trolling you and just like, because we do a lot of stuff, with media and podcast shows. I've done 2,000 of these things. And there's some haters out there that just will critique you, even though they're not doing anything on their own, but they'll critique how you do things, or you should do it like this, or like, how do you deal with that?
Yeah, so I mean nowadays I only hear from haters once because they get blocked after that, so I never hear from them again. But it's like it depends. If it's a actual criticism, like I'm very open. Like I'll even be like, hey, let's get on a call. If it's like a criticism of, I think you could do this a little bit better. Here's what I noticed. I'll have that discussion willingly because I've learned actually a lot of times people think they're haters, but they might be your biggest fan. They're just trying to get you to see something or improve on something that, it could help. So depends on how they come across. If they're coming across asking a genuine question, they feel like they're genuinely interested, I'll have a conversation and try to understand their point of view. And maybe we disagree and we're like, okay, maybe this is not for you, or we just disagree on this thing. You should probably go find somebody else. And then that's that. But if it's like a hater comment that you might get, sometimes they happen on like YouTube or whatever,
Yeah.
just like I block and I move on because it's like I don't have time for that to engage with somebody who's clearly closed-minded. I mean, if you
Yeah.
don't want to use your real name or a display picture of yourself, we're not having that conversation. I'm not talking to an avatar that I don't even know who it is. So I only engage with people who have their real name, their display picture, because at least it's a real person willing to put their name on the line rather than some keyboard warrior sitting somewhere. So I don't engage with that. Life's too short to be engaging with people like that.
Yeah. When you were writing your book, Success Journal, and prepping for success, what was the hardest chapter as you were writing it that you were like, oh man, the imposter syndrome started kicking in and like all these negative thoughts that you had to overcome? Like, what was the hardest thing to write in those books?
I think the book for me was not hard to write because it's like I never intended to write it as a book. Like these were actually notes to myself. So I had worked on myself a lot. I hired tons of coaches, mentors of my own. I attended like a lot of spiritual retreats, seminars, coaches. Like I spent a lot of money on my personal development, like over $1 million at this point. Right. And then, even going to like charity dinners with billionaires, donating to their charities so just I can have lunch with them. So I learned a lot of things. I put it down. Okay, Anmol, what are the 10 things that you need to do in your life to go to the next level? So I wrote like this book for myself
Mm.
on everything that I learned in my journey, like notes to myself is kind of what I learned.
Yeah.
So I put it down and then, I had some friends over, they read it, they were sitting on my desk, they read it, they're like, this is actually pretty good. Like you should turn this into a book. And I was like, maybe, I think that's a good point. So at that point, I hired an editor. I'm like, hey, these are all the notes that my mind dump over here, turn it into a book, like make it into a chapter, organize it. So I had
Yeah.
somebody kind of organize that and turn it into a book. So I don't think it was hard to write. because I was just being myself. Like the book, literally, the first chapter of the book starts with, "There is nothing new here. You've probably read it all before in some form or the other. There's nothing new that I can teach you. Anything that's already not written by Tony Robbins or the Bible or whatever, everything's already been published out there. It's just that I've taken it into 10 simple keys that help me, and here's how it can help you. So I'm not trying to pretend to be like this guy who came up with this original book. These are nuggets that I've learned from everybody that I've crossed paths with."
Yeah. Man, I appreciate you sharing. All right, so for the audience who's interested in learning more about your books, maybe checking out your programs, where can people go to connect with you and learn more?
Yeah, I think the best way if you're interested in trading would be to go to livetraders.com, and where if you make a free account, you can make a free introductory course that I taught. It's like 2.5 hours on the intro of my strategy. So that's a great way to start if you're interested in trading. If you're interested in my book, you can get it on Amazon, Barnes and Nobles, wherever you get your books. It's called Prepping for Success: 10 Keys for Making It in Life. And to touch base with me, Instagram and Twitter is where I'm the most active. My username on both of those is Delta90, DELTA99ETY. I had it a long time ago. I haven't changed it, and now you can't change it anyway. So that's just the username we're gonna go with, Delta90. And my website, Anmol.net. That's where you can learn about all the other things that I'm involved in addition to my trading and investing.
Cool. Thanks for coming on the show. Fellow deal makers, as always, reach out to our guests and say thanks for being on the show. If you have a deal that you'd like to talk about here on the show, or maybe talk to us about how you approach deals, the mindset or the structure and all that, head on over to thedealscout.com, fill out a quick form, maybe get you on the show next. Till then, we'll talk to you all on the next episode. See you guys.